If you're wanting to buy a home but don't have the money to do so, I'm going to teach you how you can purchase a property with as little as $1,000 out of your pocket. By the end of this video, you're going to know the different products and programs available to help you accomplish just that. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20+ year career in mortgages, and today I'm going to help you. So let's get right into it. So the first thing we need to do to accomplish the purchase of a property with only $1,000 out of your pocket is look at 100% financing loan options. This means that you're not covering any of the down payment because they're all covered by the type of loan you're getting. So let's start off with the first type, which is a 100% FHA mortgage. And you may not have known that exists, but it does. Most FHA mortgages require you to put at least 3.5% down. And make sure to subscribe to my channel to watch videos on FHA mortgages or all types of mortgages specifically. But a 100% FHA mortgage does exist, and here's how it works. So first option, FHA 100%. So I said that you normally have to put 3.5% down, or it's most common to put 3.5% down when you're getting an FHA mortgage, and then you borrow 96.5%. But with an FHA 100% financing loan, you actually have two mortgages. So the first mortgage is for your 96.5%, right? Like you would with any mortgage. But you're also getting a second mortgage for what normally would have come out of your pocket, the 3.5%. And 96.5% plus 3.5% equals 100%, right? That's where 100% financing comes from. The way it would normally work is this second mortgage can come in two forms. You can have a repayable version, which is exactly what it sounds like, you're paying it back, or a non-repayable, meaning you don't have to pay it back. Now there's caveats to each. If you're going with the repayable, you're going to have a monthly payment on that second mortgage. Now keep in mind, it's not a big second mortgage, because if we're talking about let's just say a $300,000 property, right? Well, this second mortgage is $10,500. It's not a massive loan. It's not, $289,000 like your first mortgage, right? That's a lot bigger. But what happens is, in order to figure out what your monthly payment is for this repayable mortgage, if you're using the repayable route, is you take the interest rate, let's just say that the rate right now is 6.5% for your first mortgage, right? So that's this 96.5%. We're saying it's 6.5%. Well, the way you determine your payment for this second mortgage, the 3.5%, which we'll say is $10,500, is you take this number and you add 2% to it. And that's going to give us an 8.5%. You'd be like, oh my God, I thought rates were high enough as it is, 8.5%. Well, just keep in mind, as I said, this is only on the small loan. You're not paying it on your whole loan, right? And it's also allowing you to get into the property with no money, right? So you need to consider that. When you're trying to get into a property with no money, the rate should be the least of your worries, right? It's getting into a home. You can always refinance down the line. Just keep that in mind. But your payment will be based on this higher interest rate, typically over 10 years, right? So you take this number at the 8.5% over 10 years, that's your payment, right? So you have two payments now. You have your payment on the first mortgage, payment on the second mortgage. Pretty simple. But that means you have no down payment, which is pretty awesome, right? You always want to look at the positive, not what is the perceived negative. That's the first 100% financing option, right? Is doing that. Oh, and just real quick, the non-repayable option, I should just tell you, so we talked about repayable, we do non-repayable, right? Meaning you're not having to pay it back. What ends up happening if you go that route is, rather than having this second mortgage with a payment and a higher interest rate, this interest rate on the first mortgage is going to be higher, typically about 0.5% higher. So you'll have, call it a 7% on the first mortgage, and then you'll have 0% on the second mortgage, equaling zero payment. You're not repaying it, right? So you need to weigh the options, see what works best for you. You may not even qualify for the repayable option because maybe your debt to income ratio, watch my videos, learn what that means, but maybe your debt to income ratio can't support the payment that comes along with the second mortgage, so you need to go with the non-repayable option, right? So all those things need to be considered. But that's your first that's your first 100% financing loan. That would be an awesome option for you. Just keep in mind, when you're getting an FHA mortgage, you have to be buying the property as a primary residence, meaning you're going to occupy the property year round. Number two would be a USDA loan. To use a USDA loan, you need to be buying a property in an agricultural or rural area, and there are maps to search this. Your lender should be able to do that for you. And you should probably know if you're buying in some rural area, the homes are nowhere near each other, it's just underdeveloped to some degree, it's likely rural and would qualify for this. With a USDA loan, it is 100% financing, meaning no money down, right? Pretty simple. Now, when it comes to USDA loans, there are income restrictions based on the number of people in your household and where you're buying. So you need to keep that in mind. Make sure that you're going to be eligible based on your income and that it doesn't exceed the limits for the area and where you're looking to purchase. That's number 2, USDA. Number 3 of the 100% financing options would be a VA loan. VA loans are for veterans or active duty military or the living spouse of a deceased veteran, right? Keep that in mind. You can't just go get a VA loan if you're none of those, right? But if you are, VA loans are awesome. I love taking care of veterans and their family. VA loan, once again, we're talking about this, 100% financing, right? It means no money down. We already know that. What's awesome about VA loans, most people don't know this, there's really no limit on how much you can borrow. So if you're eligible, you qualify, you can actually do a $4 million VA loan if you have the income to support it, right? If you're an exempt veteran, meaning that you actually are disabled through the VA, right? I know a lot of veterans that I deal with are 10% or more disabled by VA standards. They're receiving VA disability, right? Well, you are exempt from what's known as a VA funding fee. So VA loans, I'm getting ahead of myself a little bit. VA loans have a funding fee. Now this funding fee is similar to FHA loans. And if you watch my FHA videos, you know they have an upfront mortgage insurance premium. The funding fee gets added on to the loan, right? So whatever you're borrowing, you're gonna have that funding fee. It could be 2.3%, it could be 3.2%, depending on how many times you've used your benefits, assuming you're not exempt. Well, that gets rolled in, so technically it is extra cost. But what's nice about FHA loans, VA loans, I apologize, is that they don't require mortgage insurance. So even though you're not putting 20% down, like a conventional loan would typically require you to do in order to avoid mortgage insurance, VA loans do not have mortgage insurance. And I was starting to say, if you're a disabled veteran of 10% or more, you're exempt from this fee. So essentially, there's no additional cost for having a VA loan in that scenario versus any other type of loan. It's actually saving you a ton of money, and the interest rates on VA loans tend to be lower than that of FHA and conventional loans. So 100% financing VA loan, probably the most common type of 100% financing that we do, but it's an awesome loan for those that are eligible. But not everyone is. The FHA and the USDA are going to be more common, with FHA being the most common because you can pretty much use an FHA mortgage anywhere to buy a property, and there's no restrictions as far as having to be a veteran, for example, or buying in an agricultural or rural area in order to use it. So how do we use an FHA mortgage to get into a property with just $1,000 out of pocket? So let's look at that. So we'll use FHA specifically for that scenario, and we're going to use a $300,000 purchase price for our math. So we'll do a $300,000 purchase price. We know that you're doing a 100% financing. That means that you're doing $300,000 loan amount, right? We know this is 1 plus 2, right? 1 plus 2 is referencing the first and second mortgage that I talked about already. So what's your down payment? 0, right? So we're already starting off strong, right? No money down, but you're gonna have closing costs when you're buying a property. On a $300,000 home, let's just do the simple math here. We're gonna say that the closing costs are 3%, just to keep this easy. So we're gonna take your 300,000 times 3% equals $9,000. So where does this money come from? I told you we want to show you how to buy a home with $1,000 out of pocket, which is clearly less than $9,000. Let me make this 9 a little better for you, right? Okay, so how can we get at least 8,000 of this 9,000 covered? It's not your down payment, it's actual cost. Well, that's where negotiating a seller credit or seller concession is the same thing. Watch my videos on exactly what that is and how they work. But you can get a seller credit to help cover the $9,000. So what you would need to do when you submit your offer on a property is one of two things. Either submit the offer at a lower than asking price, asking for that money. Unlikely the seller is going to accept that because that money comes directly out of their pocket. Go in at the full asking price, asking for a seller credit to cover your costs. There's a chance the seller is going to take it, being that most properties sell for 3% under their list price anyway. So giving you that credit lands them in the same place. Or another way to almost guarantee the seller is the following. So we said it's a $300,000 property, but you want $9,000 to cover your closing costs. So we're saying you're going to get in with $1,000. Well, let's just say you want $9,000. Let's just keep this easy because we already have the number here. You want $9,000. That means you need 3%, right? Well, here's how you can almost guarantee the seller is going to agree. Rather than offering $300,000 for the property, maybe this is the asking price, right? Meaning that's what they have the property listed for. You can offer the seller $309,000. And what this is doing is something that people ask me often, actually. Buyers say, is there a way to finance my closing costs? Absolutely. This is how you finance your closing costs. Because instead of buying it for $300, buying for $309, from this $309, you're going to get a $9,000 seller credit. The seller is still going to get the $300,000 that they originally wanted for the property. So to the seller, it's no different. But to you, it makes a world of difference because now you're getting the money that you need for the purchase. Meaning that if you're doing 100% financing and there's no down payment required, and your closing costs are $9,000, of which the seller is paying all of that, well, guess what? You're getting into the property with no down payment and no seller and no closing costs because it's completely covered by the loan and by the seller. So where does the $1,000 come into play? Well, this $1,000 that I mentioned getting into the property with, you're going to use for your miscellaneous items on the front end, right? This can go toward your home inspection and any other upfront costs, such as an appraisal, that you'll incur when making the purchase. Using a 100% financing program combined with a seller credit can allow you to get into a property for that $1,000 or even less in some cases. Now, what do you do if the seller is unable to provide you with the credit? Well, in those cases, you can negotiate to potentially get a credit from your realtor or a credit from your lender. And so the way to do those things, for one, is pretty self-explanatory, right? When it comes to your realtor. And not to put it out there that realtors are willing to give their commissions away because they work hard for that, but I'm just putting it out there that that is a place from which you can actually get the money. It's something you have to talk to your realtor about, make sure it's something they're even comfortable with or able to do, because most realtors, they have to split their commission with the brokerage they work for, and they're not getting the full amount that you're seeing. But I do want to put it out there that you are allowed to get a credit from your realtor, although it's not the most common place, right? Most common is your seller or from your lender. And the way it works from your lender is pretty simple. You're going to opt, right? The FHA is irrelevant because this can apply to any of the loan programs I mentioned. You're going to get a lender credit, right? So this is on top of using a 100% financing program. So what does a lender credit mean? Well, it means that the lender is going to give up part of their revenue to help credit money toward your closing costs. So it works pretty simply. I mean, you're gonna have to give something up to get something, right? It's not about all take. There's a give and a take, right? So let's just say that the rate you qualify for with no credit is 6.5%. This is your credit, this is your thing, and I'm gonna put no credit, meaning no lender credit. However, you need money to help you with your closing costs once again. Maybe you don't need 3%, maybe 1% or 2% would help you, whatever it is. What you would do is, to get the credit, maybe you're gonna say, you know what, I'm comfortable taking a 7% interest rate. But at a 7% interest rate, you're able to get a 2% lender credit. So you're taking a 0.5% higher interest rate, right? So your payment's gonna be marginally higher every month, but it's giving you 2% to go toward your closing costs, meaning it's reducing your out-of-pocket, which is what the overall goal was. Keep in mind, the rate is important. However, you're not going to have the same interest rate or mortgage forever. Most people that are getting mortgages, even if it wasn't in an environment where rates were higher, they're refinancing or selling their property every 3-4 years anyway. So the likelihood that you're going to keep this rate longer than that is so low that I wouldn't get too stuck on the rate itself. You need to determine what's more important to you, the overall cost out of pocket or the interest rate. I know both are important, but which is more important? Because if you don't have the money to get into the house, the rate can be 2%. doesn't matter. You're not getting the house, right? So taking a higher interest rate in some cases makes a lot more sense if the thing that you're trying to accomplish is bringing down your overall out-of-pocket costs to make homeownership possible, right? You can afford the payments, but can't afford the cash out of pocket. So getting that lender credit, something you talk to your lender about and see whether or not that's something they can offer. Most lenders can, as long as your debt to income ratio works at the higher interest rate. This should be an option worth considering. So as you can see, buying a home with just $1,000 out of pocket or even less is possible. It's just all about working with the right loan originator to help you accomplish that. If you want to discuss your own scenario and want to reach out to me directly, please send me a DM and make sure to subscribe to my channel for more videos just like this one.